Well, good morning, everyone. Thanks for joining here this morning for this Minerals and Royalties focused webinar around the M&A and the A&D space. For those who don't know me, my name is Tim Powell. I'm the president of the Minerals and Royalties Authority, and I'm really looking forward to jumping in here this morning. We got some great panelists. I think the last 12 to 18 months has seen a really unique time for the mineral space. Packages of scale are coming to market in a regularity that we haven't seen before. And that's really just because it's the timing of the funds that have been aggregated with private equity capital and institutional capital over the last 5-6 years are at the point where they're mature and they're ready for exit. So I think kind of going 2020 was a really strange year with where commodity prices went up and down. COVID 2021 was a bit different. We've enjoyed higher commodity prices and I think a dichotomy of investors who have backed the portfolios that exited, the different types of end buyers that have emerged, natural gas versus oil, COVID versus non-COVID, all that will really break down an interesting discussion. So looking forward to jumping in here. Before we do, just wanted to give a little background on myself and Minerals and Royalties Authority. For those who are not familiar, we're a specialist advisory firm focus on the minerals and royalty space for natural resources, primarily oil and gas, and also renewables. We provide, a variety of different consulting services, business development. We do a handful of, different types of networking events. Also do selective divestiture work for different portfolios and buy side and market mapping for investors. Particularly international investors looking to enter the space. We help formulate the strategy that's the best fit for the investment criteria, and then cherry pick the right partners and teams that are a good fit for that strategy. We also have the leading content platform in the space. This webinar will be a part of repurposed content on our YouTube channel and our leading podcast, the Minerals and Royalties Podcast, which puts out episodes weekly. The main point of all this is to bring attention to the space, educate the stakeholders, more importantly, educate investors who are looking to enter the space and participate. And that's an ongoing effort. And I think we're proud of the efforts we've made to date. And then last but not least, a newer part of our offering, which is very complementary, and that's helping with recruiting and staffing. We have such a robust network and access to everyone in the space. If you're looking to hire on, anywhere in the disciplines that a minerals team will need, land, BD, finance, management level, et cetera, engineering, we can help do that. So without further ado, let's hand it over to our panelists. Going around the horn, we have Darren Zanovich, President and CEO of Mesa Minerals Partners II. In the context of this webinar, they exited Mesa Minerals. It's a Texas Haynesville portfolio in December 2020 to Franco-Nevada for $135 million. And then we're also for Mesa Minerals II on the buy side. I know we're focusing on the sell side here, but Darren is now more of an end buyer. And I think going in the data rooms of a lot of processes, he's going to be able to add a lot of interesting perspective. And so they kicked off Mesa Minerals II portfolio with $110 million acquisition of Live Oak's primarily Louisiana Haynesville portfolio in June 2021. Moving on to Josh Camp, President and CEO of Perpetual Production. They recently exited a stack portfolio in Q4 of 2021 to a family office with backing from Silver Hill. And then last but not least, David Sims, CFO of One Map Minerals, exited some Midland Basin assets to Freehold Royalties in Canada in August of 2021 for $54 million. So I'll hand it over to each of them to properly introduce themselves. But more importantly, I think a lot of people on this call know them. Let's break down the portfolios in a little more granularity. I think I selected you all for a number of reasons. You all have different types of investors. The divestitures were different sizes. They were in different basins, and they were also divested at different times in the last 15 months. So all that adds up to some interesting commentary. And it would be great for everyone to paint some context on the portfolios. Darren, you both for the one you sold and the one you bought, and then we'll jump into the discussion. So I'll kick it over to Darren to start off.
Great, thanks, Tim. Thanks for having us on the webinar. A little bit about myself, Darren Zanovich, President CEO of Mason Mineral Partners II. We're currently backed by NGP out of NGP's Royalty Fund, which is a separate pool of capital that NGP has raised to focus on minerals and royalties. A little about our first portfolio, Mason Mineral Partners I. We were backed by Quantum Energy Partners. We put the position together over about a 2-year period. 22,000 net royalty acres. Ultimately, cash flow was projected next 12 months to be about 30 million at the time of our sale. Ultimately, as Tim mentioned, we sold the portfolio to Franco-Nevada, a Canadian gold company, for 135 million. It was a little over 2.5 times return for us and Quantum and our investors. So great outcome. Shortly after that, in summer of 2021, we got backed by NGP out of the Royalty Fund and made our first big large acquisition where we bought a large Haynesville portfolio. It's around 15,000 net royalty acres at the time of our acquisition. We have since grown that position to over 19,000 net royalty acres. Cash flow right now projected about 30 million next 12 months. We have around 640 inventory locations, about 780 PDP locations on that asset, and we continue to acquire with a complementary ground game on top of that footprint.
Excellent. David, over to you.
David Sims at One Map. And by the way, Tim, I think it's important work you're doing. I think investor education across the spectrum is one of the key elements that needs ongoing messaging. And so really appreciate what you're doing for us.
You bet.
Our sale, we'll talk about it in a bit in more detail, but exited in last summer for $54 million to Freehold, as you mentioned. It was a legacy portfolio dating back to the 2014-2015 time period, where we had an investor network of family offices and individual investors from the Denver and Houston markets. We've since expanded and have now become a more institutional focused group with currently a little over $500 million under management. So,
excellent. And then Josh, last but not least, over at Perpetual.
Yeah, sure. Thanks, Tim and Darren and David. Great to be on this panel with you. So yeah, just a quick backstory. Josh Camp, CEO of Perpetual Production. We have two separately backed and separately capitalized PE vehicles. One is with a kind of generalist fund out of Minneapolis, St. Paul, named Castle Lake. Have about 6,500 net royalty acres there with them, kind of in the core of Stack, Blaine, Kingfisher, kind of in that volatile oil, black oil window. The portfolio we're going to be talking about here today was a roughly 2,000 net royalty acre position that we put together with Kyle Miller and the Silver Hill Energy Partners team. We did that through about 45 individual transactions. Really over the course of COVID, the world had fallen apart and we took a pretty contrarian view and went right back into Stack. Put together primarily a developed asset there, about 65% developed, 35% undeveloped, and we monetized that in, I guess we took it out to market in summer 21, and then we ended up closing in Q4. So really good transaction, really great results for all involved, about a 2.5 times MOIC and about an 81% IRR. So great outcome, and it's a pleasure to be on this call with everyone.
Excellent. Yeah, no, congrats on that, Josh. I think those who are willing to go against the grain a little bit and take a chance in time where there's extreme uncertainty, you can get rewarded if you pull it off. I did a podcast episode with Nick Varel recently, and they did something similar in the New Mexico side when the moratorium was going on and everything. So it's great to see good management teams getting rewarded. So just kind of quick summary going around the horn here, right? Haynesville assets, private equity backing, Midland Basin asset, high net worth, and family offices, and then private equity backing in the stack. We have the kind of the vintage funds that were exited, 2019 with Mesa, 2014, 15 with One Map, and 2020 with Perpetual. And then the sizes are kind of in the 10 to 20 range, 50-ish range, 100+ range. So we got some diversity here. I want everyone to remember those points, because that could be relevant in the answering of the questions. But let's start in, I think, something that is an interesting one, and that's hiring an advisor. So there's a lot of different things to address here. For context, Darren, you guys used Jefferies on your exit to Franco-Nevada. One Map, you guys used D-Tring, and Josh, you guys did it yourself. So I think the question is, when do you need to use an advisor? Is it purely a Rolodex question? They're going to know buyers you don't. Is there a certain size where it's expected? And without an advisor, it can be a challenge for, I don't know if legitimacy is the right word. Again, referencing the podcast episode I did with Nick Varel, he tried to do it on his own, and that was a substantial portfolio. And he actually found a bit of opposition on the other side of the table with buyers. And they said, hey, this is a little too big to not have an advisor. This is not standard. Why are we so special? And it created some angst where there shouldn't have been. And he ended up hiring TPH and had a very successful exit. So first off, is what are the main drivers? Is it size? Josh, you had a smaller portfolio, so was that a driver of it? Is it, I know all the buyers, I don't need an advisor? Is it, hey, I have certain investors, and it is required to show a transparent third-party process for that? It's just one of the stamps you need, kind of like a third-party engineering report, right? You need the stamp of Netherlands, Sewell, Ryder Scott. I'm throwing a bunch of stuff out there. Who wants to jump in and comment?
I'll start. From One Map's perspective, we have wanted advisors when, as you mentioned, a portfolio is above a certain size. So we've sold individual assets, we've sold smaller clusters of assets, but when you get to a point that you have something in the multi-tens of millions of dollars of assets, one, I think the reach and breadth of the advisors relationship network is far going to exceed ours. I don't care how many people Adam Olivier knows, or Joe Joyce, or any of our partners. We're simply not going to reach the entire market. And from our perspective, we felt like we owed that to our investors to get as much exposure to the portfolio as possible. We've sold and exited multiple packages through advisors, and without exception, the ultimate buyer has been a group that, one, we either would not have contacted, or two, simply wouldn't have expected to be the buyer. So, there's groups that you would think logically at the start of a process are going to be a natural fit, and they ought to, be willing to pay your expectation or higher. And that just isn't always the case. So that's our decision process.
Yeah, I mean, Darren, what about you? I mean, Franco-Nevada was a logical buyer, right? They were one. I know the list has grown of folks who can buy $100+ million assets, but it's still not a huge list. And Franco-Nevada was definitely, I'm not going to speak for you, I would guess top 5 going in, and they ended up transacting. So, what I found interesting, David, is you told me when prepping for this, there's just been we've always been surprised, whether it's a name you didn't know or a name you wouldn't have thought to approach in a real targeted process. But Darren, what were your thoughts kind of on market reach and surprise buyers or whatever, somewhere in between?
Yeah, I think anything over 75 million, you definitely need to have a bank involved, so people will take it serious. Like as you mentioned, I think David mentioned, you're going to have people take you more serious when you are that size, when you have a bank involved. And I think for us, yeah, we Franco definitely was on our list, but I think every year in the mineral and royalty space, there's probably a new surprise group that comes out every year. I remember several years back, it was Alliance Gold, and it was Franco, Nevada, and then, John Arnold was a new one that hit this past year. I think you see, almost every year with the bank's Rolodex, they're able to bring in at least one new, major buyer every year. So I think it's important from a Rolodex standpoint and just for everybody to take you serious on a larger process.
Yeah, and to add to that list, right, is Freehold, who bought.
Yeah, Freehold, another new one this past year.
I mean, everyone kind of knew of Freehold, but it's kind of like, when are they going to enter? And David's was the second transaction of last year, right? Now, Josh, to play the other side of the fence, you said, no, we ran a private process. We knew all the buyers in the stack, and you got it done with a private family office nonetheless, which is great. So what is your counter argument to their points?
Well, I don't know if it's a counter argument. I agree with what Darren said. If our portfolio would have been 50 plus, I think we would have thought about taking it potentially to an advisor. But the reality is our asset, 2,000 net royalty acres, somewhere in the kind of 10 to 20 million range. Stack is what it is. It's kind of a beast in of itself, just given not many people want to play in the Anadarko Basin, at least historically. So we felt from a Rolodex standpoint, we kind of knew the 12 PE names to go to. We kind of knew the 11 family offices to go to. But the interesting, the interesting dynamic about our process was we didn't make anyone sign CAs. We just said, here it is, let's go. It's, you have 15 days to come back to us. So we wanted to run a really, really quick and tight process. But, with not having people sign CAs, we kind of knew that naturally this was going to get in people's hands and it was going to float to other folks that, we didn't actually anticipate would be involved. So the family office that we actually transacted with was actually brought in from kind of a party that was trying to play middleman. And the team, the family office that ended up buying, knew myself and Kyle Miller well. And so he kind of cut out the middleman and called me and said, hey, can we get involved in the process? There's someone trying to play in the middle here. So that was a pretty interesting thing that fell out from our process, and not something that we didn't necessarily expect. But it's funny, even in a marketed process, there's just a lot of people who are going to try to insert themselves in some way, shape, or form.
That's actually interesting and very smart. It's kind of like that's always the challenge in the mineral space, is some landmen get a hold of it and press the forward button, and that's always the concern, right? But you almost took it the other way. It's like leaking to the press and saying, I don't want to talk about this story, but I want this story to get out, type of thing. And it ended up in a positive result. An unconventional way to do a full-blown process. I like that. That's interesting. What about, Darren, we're going to talk about the kind of the selection process of an advisor, because now you've made the decision to get an advisor, and then what kind of criteria go into that. But before that, you've always been pretty adamant. You've talked about this on podcast episodes about engaging buyers before the marketing process. And this is not you trying to undercut an advisor or like get a quick sale. You have full intentions of engaging Jefferies at this point. We've already engaged them and kind of put it on the back burner because of COVID, but continually of out there. I mean, you're constantly going to dinners that I'm putting together and networking events, having your own private meetings. Why do you see that as a good exercise? And, time is money. You guys are busy. Why not let the advisor do that?
Yeah, we're big believers in kind of what we call our pre-marketing efforts. And I'd say, on Mesa One, it was even 6 months plus before, hiring Jefferies and launching the process that we started actually sitting down, whether it was a dinner or lunch or going to the office and sitting down and literally opening up the kimono and showing these groups here's what we're building. It's going to be on the market in a few months. And then really trying to better understand what's their schedule on timing. When are they in the middle of a capital raise? Are they in the middle of working on another large process right now? What's the best timing wise for them to really make sure they're going to be there? So I think for us, we felt like we knew, even though we launched in the middle of COVID and we launched in the middle of the oil price collapse, that we were going to have 5 or 6 groups there. I'd say the other thing is, a lot of the ideal end buyers for these type of royalty portfolios are groups that cannot move in 30 to 45 days. So they may have never even worked the Haynesville Basin, for example. And so it may work better if we engage earlier with them and do almost a basin study and hire Jeffries to help us with the basin study, sit down with that group, so that in reality, they get more like 60 to 90 days with the process, which is more like what they're going to need. I think you'll find that you maybe even be able to convince an end buyer that normally wouldn't have played that basin to play the process if you engage early. So we had really good success with that. And everybody that we engaged early that said they were going to be there at bid day came to be there at bid day, which was great.
You bring up a point, which is going to be a later question, and that's identifying where they're at. Are they fundraising? Are they looking at another process? That's really smart. So, and I was going to approach the question in a different way, and that's there's a lot of assets going to market right now. And for the most part, if someone wants to sharpen their pencil and really take a run at something, they have to pick their horses in terms of, okay, we're gonna make a run at this Mace asset, we're gonna make a run at this one map asset, right? And I'm gonna open this up to the broader panel. To what degree is there, because we're all friends, right? I mean, everyone's a competitor, but they're friends because you can do deals with each other. You're a buyer one day, a seller another day. And it's quite an incestuous space, the mineral space. No secrets are kept too long. But you kind of see this amicability across the space. Is there kind of this unspoken coordination of, hey, I'm going to market in 3 months. I'll stagger it. I'll do it 2 months from now, or you space it out, or is it really just you can't coordinate that? Because, I think everyone realizes that if transactions close are good for everybody. So if you go out to market at the same time with the same size asset or the same basin, you might end up hurting each other and not maximizing value, or is it really, screw them, they're the competition, we want to get first pick on the top buyers? I don't know. What are your thoughts on that? Because that's a kind of an interesting, tricky line to dance. Maybe it just you do that with very, very close relationships and not everyone. Who wants to tackle that?
I'd say that there's probably 2 more considerations that perhaps weren't mentioned. One is there a forced timing that makes you go to market within a certain window? And so in our case, our partnerships we're coming to the end of their original lives, and they were set up in such a way that there was meant to be a distribution in kind feature for all of the investors. Most are oil and gas professionals and entrepreneurs who simply wanted long-term exposure to the Midland Basin. I think what they ended up not wanting was long-term exposure to division order processing and check cashing and revenue tracking from the 50 plus payers that might be involved at any given time. But the other piece is that if you are going to select an advisor, a lot of folks won't have competing packages at the same time. And so, you're not only looking at what is in the market or what you expect to come into the market based off of, whatever you pick up at the bar, but, what availability does an advisor have? And do they anticipate, hey, I'm about to go to work on this and that's going to take me out of the loop for 3 or 4 months. And so you've got to consider that as well.
Any other comments?
Yeah, I mean, for us, because it was the Anadarko Basin, just in general, there's not really that many people who are taking assets to market. I think in the Permian, that's probably a different beast in and of itself. So, I mean, I can certainly, imagine and appreciate it if there were folks out there who kind of wanted to coordinate the process so as to not step on toes. However, at the end of the day, I think we're all capitalists. Those that back us are all capitalists as well. And so, no one's not going to take a deal to market because of, not wanting to step on someone else's toe if the market fundamentals are there to kind of take it out. I think with this oil price swing, I think the last thing that people are frankly thinking about is not wanting to step on other people's toes. It's wanting to take advantage of the current market.
No, that's fair. On that comment of the swing up in prices, and Darren, you've mentioned this as a buyer. There's a lot of people who say, well, hell, gas is up, oil's up, great time to test the market. And this goes back to the question of, is an advisor involved? Darren, you've voiced a lot of frustration on people who are kind of kicking tires, and it's almost a waste of y'all's time. You dig in and they're not a real seller. They're just looking for unicorn pricing. So maybe, is there an advisor involved? A is one criteria. B, how engaged do they seem? Do they have an ask, a formal process? Just what are some of the things, kind of signals around that in a, I'll call it a noisy market, right? With lots of stuff coming to market. How have you gone about picking the ones that you want to invest your time in, or what are the lessons learned, Darren?
I think for us, it's more in the smaller market, like the $5 million to $50 million market, where our strategy in the Haynesville right now is kind of a complementary strategy to add acreage on top of the footprint we have. So as part of that, we've looked at several of these packages in that range, and I'd say most of them have been family office type groups that historically have not been sellers, and they're coming to market either with a banker or a non-marketed deal. And we've looked at it and we've given them a good solid number on it. And ultimately what we found with a lot of those groups, they're just looking for an absolute outlier or a mark on their portfolio. So it has been frustrating to work with several of those groups. So I don't know, I guess that lesson we've probably learned is, if it's a family office group that's never been a seller, historically, maybe we don't waste our time there, and we move on to somebody like maybe that's backed by private equity, or somebody that's raised a smaller, friends and family fund that's like longer in the tooth and looking to exit.
Okay. Well, great. Well, kind of last point on the advisors, what kinds of criteria do you go in? Do you weigh more heavily when looking to engage them? David, you talked about a past relationship with Dietrich. They had actually, they were familiar with the assets and had sold some of them in the past. So there's kind of the relationship aspect, which is always huge in deal making in general. There's basin experience. How do they have a track record of selling stuff in a particular basin? I know on the New Mexico side, TPH has gotten a good name for itself of late. And then the last is, and I think at a high level, you would always kind of gravitate towards this, and that's access to unique buyers. I think that's ultimately what everyone wants, but there may be certain folks have lines of communication with different types of unique buyers. What are the main drivers when, Darren and Dave, when you ended up selecting your advisor?
In our case, as you mentioned, yeah, we've got a track record with Dietrich. They actually sold a portion of these assets for us in late 16, early 17. So, they kind of had to dust off, take a look at what wells have come online over the last several years, how's cash flow going, and update their engineering. But their process, I think, is very robust, very thorough. So, whereas we internally don't build out projections for the entire position, when Dietrich took our package to market, they said, look, there's 6,000 gross locations here, and they engineered them all, and they laid out a package, and they built a picture that could say, buyer, this is how you can anticipate your cash flow growing, and just completely thorough look at the position, whether it be from productive horizon, by county, by operator. They showed just activity down to any sort of iteration or permutation that a buyer might want to observe. We do have a good relationship with them, so that
I have a question on that. So what role does that have in the ultimate process? Do you think with all that work and detail that dollars are added to the price? Do you think in a noisy market where there's lots of deals, it helps someone digest it quicker to know if they want to dive in? Because just to play devil's advocate, I think the buyers that are sophisticated, that are looking for 50, $100+ million deals, are going to have to do all that themselves. Do you think as they work through it, they go, oh shit, that's that's interesting, we wouldn't have looked at that, and then it sends them down a rabbit trail to then possibly engineer something a different way or take a different view? I don't know. I think if you have just an inventory in a spreadsheet versus a full story, it could enable someone to say, this is actually worth my time, versus them kind of glancing over it. They're busy on another project and they move on. What do you think are the major factors? And Darren, chime in after David, because you're a buyer now, right? It'd be interesting to get your thoughts.
I think everybody looks at the world a little bit differently. So, the particular emphasis or areas where a buyer puts their weighting, not for me to determine, right? I mean, One Map does our evaluation on the buy side in our way. And just because an advisor or a seller tells us one thing, I mean, we're going to approach it from the same standpoint. Which is why even though we are a ground game shop and we do hundreds and hundreds of small individual transactions, we still evaluate the large packages that come out in the market. We're going to evaluate them in a very similar manner to the way we evaluate individual transactions, so that we're not sacrificing underwriting standards. But in terms of how much does it add, I think it may get certain buyers far more comfortable. It may provide, the last push that they need with their board or their investment community. I don't know. Again, it's not work that we would typically do, but if it does bring even one more look to the portfolio, from my perspective, paying an advisor to do the work is worth it.
Darren?
Yeah, I think from our standpoint, we're, as a buyer, we're going to do our own bottoms up evaluation. We're going to stick every single section up and time it in. So, helpful if a bank does, their work ahead of time. It's a resource we look at, but, we're going to do our own work from bottoms up. But you'd asked, criteria going into hiring an advisor, and, I could walk you through kind of what we did on the Mesa One process. We identified Jefferies, 3 other banks that we felt were the type of groups that could sell our asset. We sat down with each of them, talked to each of them about, what bandwidth did they have? Do they have time? What other things do they have on their plate? Quickly realized RBC at the time had 4 other large Permian processes they were about to launch. So, Rusty and team kind of exited, left. We focused on Jefferies and 3 other groups at that point. And ultimately what we did is we got all 3 of them the data, and said, hey, in 3 weeks, we're going to have a bake-off, and literally scheduled a bake-off in 3 weeks, where we sat them all down, and had a meeting one after another, and had each of them walk through, this is what we think the value is. This is who we think you can sell it to. Here's, our Rolodex and unique buyers that we can bring to the process. And here's the strategy that we're going to use to try to sell the asset. And what that did for us was it gave us, call it 4 different independent views on what the value of our asset was. It gave us 4 different independent views on, who is the next insurance company or pension or endowment that is the right end buyer for this, that these banks think they could bring in. And then strategically, how are they going to try to market and sell the asset? So that was great for us, and really opened our eyes. And what it also does is quickly you realize which banks are going to hustle by the work they put into the bake-off presentation. You can quickly see, wow, these guys put their A team on it. And in the case of Jefferies, they did. Guy Oliphant, Greg Chitty, Brian Gittenmerv, those guys are definitely the A team over at Jefferies. And once we saw the product that they had kind of put together for our bake-off presentation versus the other banks, we were sold on going with Jefferies. So that's kind of how how we decided on an advisor.
Oh, that's great. That's great. So let's talk about timing. And what I'm going to do is I'm going to walk through. This is actually a fun exercise for me because we kind of forget how shitty gas prices were not too long ago. So I'm going to quarter by quarter
As you.
just just give a quick summary on kind of average oil and gas price to paint context for when y'all's portfolios went to market. So Q2 2020, oil was between $20 and $42 a barrel. Gas was between kind of 163 and 174 in MCF. Q3 2020, average about $43 a barrel. Gas was 177, 192 in MCF. Q4 2020, 38 to $52 a barrel. Gas starts to creep up, 239 to 259 in MCF. Q1 2021, oil's between 56 and 63 a barrel. Gas is 271, 260-ish range. Q2 2021, 67 to 76 a barrel. $2.66 to $3.26 is the range. Q3 2021, about $76 a barrel on average. Gas 384 to 516 MCF. And then Q4 2021, 76 to 85 a barrel. Gas was 376, upwards of $5.50 was the range. So that's kind of painting the context. When you guys started to think about timing and going to market, David, you had already talked about kind of forced timing based on the vintage of the fund and the expectation of investors. So let's park that. From commodity pricing perspectives, what was going through y'all's headspace and how you ultimately ended up pulling the trigger to go to market? Darren, I think it's funny. You had started this process kind of Q1, you're getting ready to go. I remember we were at a dinner with Scott Noble in Austin right when the world melted down. This was the Monday of the oil price war. And you're like, yeah, I think we're gonna pull the process. We're not going to market. And then you ended up going back. When did you decide to go back, based on kind of where the world was from a commodity pricing standpoint?
I think once we decided to go back, we kind of looked at I had mentioned RBC had 4 or 5 big Permian processes that they were planning on launching when we were talking to them initially, and then when we came back kind of after COVID, everybody was still working from home. It was starting to get a little back to normal. We took a look at the market, and there was literally nothing on the market at all. All those Permian processes had been pulled. I mean, combination of oil price pullback and COVID. Nothing on the gas side was on the market. We had pre-marketed it and talked to 5 or 10 different groups that we felt like were going to be there. We kind of re-engaged with them and got confirmation that they were going to be there in the process. And so we thought it was actually a great time to launch, and kind of took a contrarian view and did launch when everybody was shut down in COVID, and ended up being the right call.
Do you think in a market where you're the only game in town, if there are, I don't want to call it capital requirements, but end buyers are, to continue to grow, replace declines in cash flow, need to make an acquisition or want to make an acquisition, it could be more fruitful if you find yourself in that situation, even though, I mean, it's hindsight's 2020, but gas starts to creep up over $2 in Q4 2020, but it's nowhere it is today. But competition and a bit of a bidding war can maybe drive up price. You think that scenario more times than not is going to be advantageous versus going into a noisier market? Was that the view?
I think the view for us at the time was, we had acquired the asset really at probably $1.50 to $2.50 gas prices. We had actually, at the time we opened the data room, I think gas was actually around $3. And for us, we didn't need to sell. We saw a window with some interested parties that we're going to focus solely on our asset, and so we thought that was an important window to hit. And our thought ultimately was, if we don't sell this, we can put it back on the market in a year from now. So our production profile had just ramped up and was literally going to be flat for the next 3 to 4 years. It was the perfect time for us in the life cycle of the asset to sell it. And we did have the attention of some key groups that might have been, busy with other processes had there been more stuff on the market. So hard to tell, but we had a great outcome either way.
Awesome. David, what about you guys? Oil's starting to creep over 60 and
Yep.
you're starting to think, okay, this could be a good time. What was the thought around kind of the pricing in the market?
I mean, if anything, there was a sense of relief, right? That things were starting to trend up, not only in pricing, but in our case also rig count, right? So there have been probably 15 to 18 months of I wouldn't say no divestiture activity, obviously, but minimal. And you're coming into a point where it looks like there could be buyers with asset acquisition mandates. Interestingly, I mentioned that these were longer term holds. Our acquisition environment started when oil was over $100, right? And then it was we were buying kind of on the way down. But in our case, we aren't buying cash flow heavy assets. We're buying heavily undeveloped, at least from a horizontal perspective, and looking at these as growth partners. Now, our trailing 12 cash flow in that environment, was slightly over $3 million. But for 22, with more rigs coming in and activity beginning to ramp up, we were thinking 22 cash flow could easily double that. So, did the buyer end up looking at us as a more of a cash flow plus some upside? Again, I don't want to make that determination on behalf of the market. I want to know. I want as many people to see the asset as possible, evaluate kind of the macro environment, which includes price, and hope for the best.
Yeah, I have a couple of follow-up points on that, but I'll loop back. I just want to go to Josh. So Josh, let's talk Anadarko Basin 2021 and 2020. I mean, Anadarko Basin in 2020 was a bad word. You couldn't say it out loud and get without getting a nasty look. Rigs start coming back, oil's going up. Was it more a product of where your portfolio was or where the basin was and people are starting to look again? I mean, what were the factors that came into play for you?
Yeah. So for context, we're talking the Anadarko Basin here, 2020, frankly, even late 2019, the rigs have really ran away. So really trying to go out and chase kind of an undeveloped nav story there. There just weren't enough rigs to really support that. We had come up with a pretty analytical, data-driven strategy that, at least for the rigs running, we had a really good way to get out in front of them and capture as much of that undeveloped upside as possible. But when 2020 hit, I think no one really knew kind of what operators' plans were going to be, and if they were actually going to do what they said that they were going to do. And so we kind of just turned on a dime a little bit. We had really flexible capital, very nimble mandate there. And so when prices kind of in Q2 2020 went to 20 to 42 bucks a barrel, we just said, let's buy as much cash flow as we possibly can, as much flush PDP as we possibly can, kind of at PDP 15 to 20. The world was falling apart at that point in time, not just for the oil and gas space, but I think as a mineral owner, you went from getting a bunch of mailers to getting none. You are seeing your revenue checks just fall off a cliff. And so really being able to go in and try to transact in a $30-ish a barrel environment and buying PDP at those sort of discount rates was extremely attractive. And I didn't think at that point in time, I don't think that we expected the world would whipsaw like it did. But as soon as it did, and knowing that, we had a kind of a 65%-ish developed portfolio, and everything's falling off a cliff, so let's take advantage of essentially the fact that our basis has now doubled or more than that, just based on $1 per barrel price point. And then on top of that, there were 9 rigs running in stack when we went to sell. 2 of those rigs were on our asset. They were both Oventive operated rigs right next door. to each other, doing some kind of cube development there. So 22% ish of the rigs and stack are on your asset. And quickly that turned into 15 to 20 ducks. And so given kind of where price had ran, plus now on the kind of remaining 35% of our portfolio that's undeveloped, well, now you can actually kind of sell a development story. And so that's how we thought about the world.
So, Darren and Josh, it sounds like both of y'all had that kind of ideal scenario in the life cycle of the assets, right? They were over that, 50% developed mark, give or take. Darren, you'd mentioned projected cash flows kind of plateau. So this is just a really good time to exit. Josh, you guys were 65% developed, tons of ducks online. And so just a great opportunity for a buyer to capture some of that flush production, right? And you guys can realize that. David, going back to you, what I found really interesting is, that asset was largely undeveloped. It was less than 20% developed, I think. Now, and this is a good lead into the next question, which is rifle shot versus shotgun on your marketing approach, which is better. And I feel like I have a pretty good personal understanding of who does what and investors behind them and what drives strategy. I would not have selected Freehold for that portfolio because Freehold largely buys developed assets, and they bought a pretty undeveloped asset from you guys. Fast forward a couple of months, they buy a largely developed asset in the Eagle Ford. So when you start to play match make in the broader portfolio, they're getting that blend they want, but kind of it lends itself to that wider approach. In your case, matters and adds value because you don't know exactly what they're cooking in the kitchen, right? And how they're trying to put it together. So to the broader panel, I know we talked about this, but we've all had that kind of rifle shot versus shotgun discussion in our head. Is it what are the downsides of going wide? Let's start with that. Why would someone not want to do that? Does anyone want to take a stab, or why have you not done that in the past?
I mean, I think for us, we took a rifle shot approach because we knew who the buyers were. Most importantly, we knew they all had capital. I think in today's market, I think that's the biggest fear of any process, whether you're on the buy side or the sell side. I mean, when you're on the buy side, there's a lot of people out there that don't have capital, that are, throwing around values and putting in offers. And a lot of times that can derail processes on the buy side. On the sell side, same thing. I think we went out with a rifle shot approach, but because we didn't make people sign CAs, it almost kind of turned into a shotgun approach, and people were trying to play middleman. So frankly, I think the biggest fear for us when this family office showed up, how do we know that you guys have the capital to actually close? And I think that was the big concern. And had it not been someone that we kind of directly knew, that Kyle directly knew, and that I directly knew, I think we probably would have taken one of the offers that wasn't at the top to kind of have surety of close. And I think in today's market, that's one of the big things that, especially we're seeing on the buy side right now, we're seeing a lot of processes get totally derailed because there's a lot of people that are running around without kind of real capital.
Yeah, I mean, let's jump in. I'll circle back to some other points on this question, but let's jump ahead. One of my questions was evaluating offers and the criteria that your management teams really put a lot of weight on. And you just mentioned, Josh, hey, they could be the high bid, but if we don't have a certain degree of certainty or a higher degree of certainty on, are they real? Can they close? I don't know if they have a track record or they're a first time entrant into the space. So it's not always the high bid. Walk through, as y'all reviewed your offers that came in, things that went through your head, factors that were at play that were important. I'll throw it out to the floor. Anyone can jump in.
Yeah, so I guess for us, I found it interesting on our process, when we were selling, um, similarly to, the Franco Nevada process, when we were the buyer, I think it was real similar where you had, 20, 30 groups that signed NDAs, and then you ultimately had 12 bids. And then ultimately you had 2 or 3 bids that were real. And then you had a whole bunch of guys that were trying to buy it for PDP, duck, and maybe permit value, which, these type of large cash flowing aggregated portfolios are not going to sell without somebody valuing the inventory. So I thought that was interesting. We felt good about our process, going into, the acquisition of the Haynesville asset that we made. We had just sold our asset right over the county line right here. We knew exactly all the buyers that came through, and we knew exactly where they bid and how they viewed inventory. We knew Franco Nevada was not going to play this process that was coming up. We knew that the group that was in second on our process wasn't going to play the process. So we felt really good about market intel. I think more than anything going in, we kind of bid it almost to perfection, where I think we hit the number that was probably on the low end of where they wanted to sell. But at the same time, it was enough to get them interested and beat out the competition. So we used a lot of the market intel, and that's another reason why we play every single one of these marketed large processes, because we just learn more every day when we play them about the market.
Just a quick follow-up to your question, Tim. When evaluating bids, there is the, are they real? Not only from a financial wherewithal standpoint, but do they understand the asset, right? So as we get into discussing terms on our PSAs, does it look like they're going to have, much tighter ranges on what might give rise to walk rights? Like, do we feel that that there's something there that could make them during their post PSA diligence period walk away? Is there, are they looking for non-standard protections that simply aren't needed, that could, in the very low probability circumstances, come back and somehow bite us and make us have to start the process over? You've got to look at that. And back to the devil's advocate question on rifle versus shotgun, the one piece that occurs to me in terms of why we have gone marketed versus rifle is when there's conviction around selling. So, just as we want to know that buyers are real and that buyers are going to follow through and execute, I don't want to signal to the market that we are intending to transact when that may not be the case, where it may be, look, we're going to sell if the circumstances are right, and you, very small group of bidders, have a chance to take a look. But I don't want to lose credibility with anybody, and I think that that's an important consideration for our selection process.
What about offer types? Cash, earnouts were, versionary structures were more popular in 2020, I think, to bridge the bid-ask spread. Higher oil prices now, more cash in the system. I don't think there's a need for those right now. They'll come back for sure, but the cash plus stock offers, is something publics have had to do in recent years. How much does that come into consideration? Cash is king, obviously, but what is everyone's thoughts on that?
Go ahead, Josh.
Oh, yeah, real quick. I think for us, our asset was small enough to where, we just had to have all cash, or frankly, the capital that we had behind us was patient enough to kind of just let it be a distribution story. I think we were all fine with that. The yields on the asset looked great. So I think for us, if anything would have showed up other than cash, we probably would have just we probably just would have continued to hold it and just ride this commodity price wave.
Yeah, as we would think about receiving something other than cash, the more investors we have behind a specific partnership, it just increases in complexity on an exponential basis. So cash, leaving a partnership open, ready to receive a contingent payment is just a giant pain. And so you kind of have to weigh the administration cost between now and whatever that trigger event might be, investor willingness to accept that. So, from our perspective and for most of our assets, cash bids are going to receive a giant premium.
What about international versus domestic buyers? Canada, I think they've been playing in this space, so there might be less angst around this, but nonetheless, different currency, cross-border tax issues, potentially. Darren, you sold to Franco-Nevada, Canadian company. David, you guys sold to Freehold. In that experience, anything different compared to U.S. buyers, or really any challenges or differences that might pop up was all handled internally on their end and it was smooth sailing as a seller? Any comments there?
Nothing on our end. I mean, I think Franco-Nevada has gotten, several different portfolios over the years, and they've got it down pretty well when it comes to the U.S. So we had no issues at all from that standpoint.
Yeah, we've seen Freehold transact in the U.S. There were no regulatory concerns. I got to think that I haven't checked up on CFIUS regulations recently, but if you start to have buyers from less friendly regimes, that could possibly become a consideration. But ours was handled U.S. dollars, easy.
Yeah, I mean, I think Josh, going forward, because I'm working hard to bring some international families into the space. I think your size transaction is probably more where they'll play. They have to have the sophistication to set up the blockers and the entities and all that. But, one thing I found is if there's any type of debt component, lenders in the U.S. that understand minerals don't want to lend to them. They need a U.S. management team. So that is a unique challenge. I think we all kind of fantasize about these new end buyers coming in and international players with yield. I think there's a reason they end up being LPs and funds like NGP Royalty Partners, right? So nothing that can be overcome, but a factor at play for sure. We're starting to run down of time. There's one thing, and this is, sorry I saved it to the end, but I think really important and relevant to a bunch of the processes that are going to market, that are out to market, and just in general in minerals, I think cutting up a portfolio is far easier than in operated. So you have a lot more optionality. But let's talk about the formulation of the strategy. Darren, you talked about seeing the view of 4 different bankers, having your own view, and that helps maybe put together the recipe you want. But some things that are out there, right? Deal size range. Is there an optimal range you want to, sell an undivided interest in your portfolio, or break it up into packages so that it's different bite-sized chunks, and that gets you the most competition and will maximize the value? Is it by location, splitting up basins, or splitting up commodities, right? This is a gas package and this is an oil package. And then development profile, we've already talked about that, right? Do I want to split off the mature PDP and sell it to an insurance company who just wants something flat, predictable, that can be hedged out, and then more the upside and the permits and the ducts to flush your stuff, that type of buyer, and breaking out that way? How have you all kind of thought about dissecting things? And is that good, or is it, there's a saying, I'm a big Tony Robbins fan. He has a saying that says the human brain can only function with up to 3 things, and the human brain goes 1, 2, 3, fuck it. So is too many options prohibitive? And someone who's busy goes in and goes, oh Jesus, there's a lot going on here, too much, pass, right? And you need to, the counter argument would be, someone's busy, you need to do your homework, like you're saying, Darren, know what they want and say, hey, you're looking for steak and mashed potatoes, here's steak and mashed potatoes, evaluate it. What are your thoughts? I threw a lot out there, but we're coming at the end. I want to try to touch on all these things. Who wants to comment?
So, our smallest, or one of our smallest marketed packages sold in 2019, we used 10 Oaks, who did a great job for us. And, specific to your question, we had assets across 29 counties. So, it'd all be considered greater Permian, but it wasn't the type of package that you would see from one map today. We ended up having 4 separate buyers for that package, and they were distributed, along the lines of what you were talking about. There was a cash flow package. There was some growth in Midland Basin. There was, different things. Again, that is exactly a sort of reason that we would use, even on, a package that was less than half the size of this freehold one, that we would use an agent to help us out, because that is a lot to manage. That 4 is more than 3, and we get to 1, 2, 3. Holy shit! So that's a lot going on for our shop.
Yeah, Brooks McKay from Jetscream just had some successful exits. I know he was interested in joining this, just couldn't make the timing work. He engaged 10 Oaks and spoke very highly of them as well. So I want to make sure give a shout out to 10 Oaks. They cut up the portfolio, right? Eagleford, Midland Basin, Delaware Basin, Haynesville, and had a lot of success. Don't want to speak for 10 Oaks, but it seems that's maybe a specialty or bread and butter they're bringing to the table is, hey, we have some experience slicing and dicing here, and can maximize value that way. Is there any concern of you're not comparing apples to apples? It's hard to figure out, if you're getting an offer for 2/3 of it, and then you got all these kind of smaller offers. I guess it all comes down to math and metrics, and there is a way to kind of dissect that, but it's trickier, no?
Definitely trickier. Yeah. I mean, and it again, it's there's staff considerations on our side. How many different diligence processes are going to be run at one time? How many groups do we have to respond to? Will there be any residual assets that need to be managed as a result of splitting this stuff up? And so, that's difficult. I don't think, and I you may have asked this, it's not a consideration for us as we build the portfolio, how or the manner in which we're going to exit. So if we end up selling our existing assets, through 15 different processes, I'm okay with that, because generally speaking, we have longer term money behind us, we can hold, and it's long been our contention that the market for minerals 5-10 years from now is going to look very different than it does today. So it may end up being easier to slice those things apart, or to tranche them out.
I mean, to kind of wrap up and a follow-up to that point, I mean, Darren, you built a very consolidated story, which is quote unquote cleaner on an exit. Josh, I think you could argue you did the same, right? However, Darren, going forward, you currently have a Haynesville portfolio, but you have the mandate to acquire other basins. So that kind of consideration on, what you do on an exit will and may come up in the future. So any kind of follow comments on that in terms of maybe how you built the portfolio for the exit, or just once you value buy and build something at a good cost basis, looking at best ways to monetize it?
I think for us, it's still, we would like to build something in another basin that looks a lot like what our Haynesville position looks like today. Ultimately 20,000 net royalty acres, call it 30-40 million a year cash flow, 50-50 PDP inventory. If we can build that in another basin where we have a consolidated position concentrated in a certain area with a handful of operators, a handful of type curves, a handful of spacings, I think that's going to sell better to the current end buyer world that we have right now, who I think could get overwhelmed if you have a package of 5 basins and hundreds of type curves and hundreds of different spacing patterns and operators. So we will see. There's some fantastic packages that are either on the market right now or coming to market that are, call it 100 million plus, 4 or 5 basins, some really solid stuff in multiple basins, and they are going to be likely selling it in portions like you're referring to. So TBD, I guess, on how that's going to look and how the success comes about from. There's really 3 big portfolios that fit that criteria that are coming to market. So we will see this year kind of how that shakes out.
No, I agree. It'll be interesting, and I think they'll be successful. It's just there's no one right way to do it, but it does seem like we're boomeranging back to portfolios that look like that. Whereas for a while it was, very rifle shot, build it tight. That's what the market wants. I think what that signals is buyers are becoming more sophisticated, right, and can digest that. Any closing comments, Josh?
No, Tim, really appreciate the time, and Darren and David, great being on here with you guys, and congrats on the successful sales over the past few years, and look forward to hearing a lot more success stories.
Awesome. David, Darren, closing comments?
I just really appreciate you bringing more attention to the space and continuing to host these sort of events. You can't do anything but be helpful for all of us.
Yeah, I echo. Great being on here with you guys. Wish you all the best. Tim, thank you once again for bringing, everything that you bring to the space, and wish everybody the best.
No, appreciate it, guys. And thanks for all of our attendees. I know we have some international investors that tuned in, so appreciate their attention. I hope they found it useful. For those who are listening, if we haven't spoken personally, would love to jump on an intro call or come by your office. Happy to answer any questions you have about the space. And if you are an investor looking in, would love to help educate you and help you formulate a strategy to invest with someone like we have on the panel here, or make an exit for somebody. So thanks, everyone. Enjoy the rest of the day, and we'll talk soon.
Thank you.